Hello, everybody, and welcome to another episode of the Swing Trader Weekly Status Update. It's Justin Nielsen here hosting, along with Mike Webster, the famous Webby that is back in action. So we had Dominic out for a little while, man. It's been a crazy summer with people out. We had Allie out last week, and we're all just kind of recovering from vacations. I'm going to be out next week to Hawaii, bring my daughter back to the University of Hawaii. So let's get right into SwingTrader and see what's been happening there. So, Mike, when you and I talked last week, we talked about, hey, you know what? We're looking at the feedback. Some people are saying, hey, you know what? You might want to slow things down. Wow, we really slowed things down. Did you swing the pendulum too far, or what happened?
No. Okay. So we have the Fed tomorrow, and we're going to talk about that in a little bit, but that is a big risk event. Now, not every Fed meeting, they happen all the time throughout the year. We get PCE, we get CPI, we get unemployment. They're all important, but some are more important than others, and some are very important. So tomorrow's is extremely important. And so we intentionally dialed things back ahead of tomorrow because the reality is on Fed days and lots of times the day after the Fed day, you get so much volatility. And with swing trading, your stops are tight. And we just knew that we would just get chopped up in individual stocks and get stopped out of a normal reaction. So we intentionally backed away from individual stocks one by one, switched into ETFs, just not leveraged ETFs because we don't want the extra volatility. And we have a decent cash position, but we're invested enough that if the market rips, it will participate, but we didn't want to be over our skis. So I think given the information we have now, we don't know what Powell is going to say tomorrow. We don't know how it's going to be received, but I think, you know what, this is the right way to go in. If we were going in 100% in cash, that would be a problem. If we were going 100% in risky stocks, that would be a problem. So I think we have the right balance, but we'll see how tomorrow plays out, but really how Thursday and Friday plays out. Because I've always said the real reaction to the Fed is on Thursday and Friday, not the day of the announcement, because that day is just a bunch of algos and day traders that are moving the market primarily. And then, then it switches over to, Thursday and Friday, because all the big players get to re-listen to what Powell had to say, read the changes that happened to the document, to the press release statement, and then adjust accordingly. So that's kind of where we are.
Mm-hmm.
It's a waiting game.
Yeah, right. So we're going to go, to our pie graph this time first, just to kind of show where we're at. We're basically 61% invested right now. We did get rid of ISRG today. Not that it was doing anything particularly wrong, but it was just, again, kind of to avoid those individual stocks, as you mentioned. And look, we also said that we were going to be leaning more towards the ETFs last week. It was, we kind of projected what the expectation should have been. So yeah, we haven't really done too much. It was, I guess the biggest thing is a little bit more of what's working. And that was on the IWM side, the small caps, Russell 2000. So a double position there. Builders still working, our equal weight RSP, that's still looking okay. And then we added the mid caps. So that's really kind of our big add recently. And, that's an area that has been looking strong. Cash position is high right now. But again, that was something done intentionally ahead of this Fed. And just, this isn't unusual. I was kind of looking at some of our past trades and invested percentages. With the March Fed meeting, we were 16% invested before that. With the May 1st meeting, 22% invested. We were a little bit heavier on the June, and that's kind of to your point where they're not all created equal. We were a little bit heavier there, closer to the 90% range in terms of our invested percentage. So a little bit heavier on that one. But let's go ahead and we'll take this down, and we will go ahead. Or did you have any comments on the pie graph before we move on to the charts, Mike?
No, I think it's just pointing out that all of this exposure is all ETF and all on purpose, just because, especially with like the IWM, you've got 2,000 stocks, 400 for the MDY, I believe, and so things are really spread out, and that's where we're going. We want to have the exposure to the area, like you said, that what is working, but we just don't want to be over our skis, especially with the intraday. Anyone who's been around for a while and has traded on Fed days, that intraday volatility is just can be extreme. And so if people aren't kind of up on what's going on with the Fed, the market is anticipating several rate cuts this year, like 3 of them on balance is what people are thinking. So not tomorrow, but the assumption is that Powell would tip his hand that he's going to be cutting the rest of the year. Market thinks that we're going to have 1 at each of the remaining Fed meetings this year. To date, everything that I've heard him say doesn't jive with that. And so I think there's people in my camp as well who are saying, okay, Powell said that he's basically going to wait and wait and wait really too long, frankly, before he makes that shift. But the market is saying, hey, he's going to make these cuts. So tomorrow is a big day, and he might just kind of take a pass and then make the change at the Jackson Hole meeting, towards the end of August. But that's the big unknown going into tomorrow. So if he comes out and says, hey, no, nothing has changed, and we don't have any plans on changing anytime soon, then the market's going to have to reevaluate. That's going to hurt small caps. It's going to hurt mid caps, and it's going to hurt the real estate area. So that is a big risk.
And the reason, of course, is because what has been happening is this 10-year Treasury yield has been coming down. It peaked out in October almost at 5%. Really kind of dropped sharply. And remember, this was a nice rally during this time. November 1st was our follow through day. And then it kind of came up a little bit, topped right around that bottom that we had in April, as we were pulling back in April, when people were starting to get concerned again. Is this 10-year Treasury yield kind of creeping up? And we've really kind of been in a downtrend since then. A lot of kind of upward thrusts, but so far, I mean, this has been a pretty big downtrend for the 10-year Treasury yield, which has led directly to more power in the Russell 2000 small caps, the MDY, which is the mid caps. If I didn't identify that before, the S&P 400 mid cap index is what that is kind of going off of. I'll just show what that looks like right now. MDY, the S&P mid cap 400 that is holding up pretty well. And again, we should contrast this with what's been working for most of the year was the Magnificent Seven trade, the whatever you want to call it, the $1 trillion club trade. That was what was working for most of the year, but that topped out here in July. We had this downside reversal that at first looked like it was going to be a nothing burger again, but really has turned into something. And that July 11th is when we put on the XHB, which is the home builders. That was on July 11th. So this day right here on that downside reversal on the NASDAQ, that was also when we went with IWM on that day, July 11th as well. And those have just been doing very well, especially if you do the comparison, looking at the relative strength of these versus. And so those were the two that we held through this whole time. Now we have added some other rotation plays, but we got shaken out of some of those. So let's talk a little bit about ITA. This was a aerospace and defense ETF that we had on. And, when we put it on, we also kind of did a double whammy with, GE Aerospace was looking good. That was looking like a breakout. So on this day here, July 23rd, we added GE, we added ITA on that day as well, because that was looking strong. looked like a breakout here for ITA after a nice little pullback. That was exactly what we wanted to see, that pullback, supported the 50-day moving average line, added it right there. And then the very next day, man, that just came right back in. So it did undercut the low of our entry day. So we kind of were forced out of this one. But what were your thoughts on that?
Yeah, I mean, look, it's frustrating getting shaken out of something, but you always want to look at a trade, and you're going to have good trades and bad trades, and good trades don't always make money. Bad trades don't always lose money. If you're trading from a position level, basically kind of orthodox, more like what leaderboard does, you can put an ITA on there when we did, and leave it till Friday and see how it closes on a weekly basis. That's kind of an orthodox, more Bill O'Neill, the founder of IBD, style of doing things. He wasn't a big ETF person, but as far as just any type of breakouts, giving it a little bit more time. But if you've got your swing trading hat on, you need to have lines in the sand, and a close below the low of your breakout day is a sell signal in the swing trading world. And so you've got to take that. Now, what we could have done is put it back the following day. We are intentionally trying to slow things down a little bit, and not, put something on, take it off, put it back on, because, we want people to be able to kind of follow along as best as possible what we're doing. And we know that that's a struggle for people to buy things right back. So, but on top of that, we had the earnings season with a lot of stocks in that group reporting during that time. And as much as that, bounced right back, that was on earnings results. And so all earnings, every single earnings is a crapshoot. And so you didn't know that was going to happen. You could have easily, on a bad earnings reaction, been down as much as that was up. So I think it was prudent. In hindsight, buying it back would have been the way to go. But as we said, we're trying to slow things down a bit. If we didn't have the Fed right in front of us the way we have, we might have just put it back anyways. But we are intentionally trying to slow things down. Don't expect this pace of slowdown. It's kind of like trading in molasses. I think we only did one trade today, and that was just removing a quarter position in ISRG.
Yeah, exactly.
And yesterday, did we do anything? Maybe.
Yeah, we did two trades. We kind of trimmed our the service now because that just wasn't working. So we took off now because that was just looking like, even though this day didn't look too bad, it still was in the upper part of the range. We just really didn't have a choice yesterday, because now you're in the lower part of that range. And even though we didn't undercut the low of the day, it was still, did we really want to go all the way down to the low of the day? That would have been a big loss.
And this is a good teaching moment. So when we put something on, you want to look at it and say, hey, this is an education informational service. When you put something on that we did on that day, we're like, we'll probably get shaken out of it. But if we don't put it on now and it works, then we're going to be chasing it later. So you got to put it on at that point, knowing that this can happen. I think it has a high chance of still working out. The fact that it's, all of technology has been just falling off, not all, but a lot of technology and high flyers have been getting hit really hard. This still looks normal because you're holding up over that your pivot day move, and you've come down in kind of a gentle way, and you had that mild upside reversal getting back up near 800 near the close. Now, of course, we're in the earnings season, so we had Microsoft report after hours. We don't know how that's going to play out in tomorrow's session, but just normally speaking, this looks good as an entry. So you could have bought it when we bought it. You didn't have to sell it when we sold it, or when we removed it, because that was, again, from a swing trading standpoint, we had to remove it yesterday. We didn't really have a choice. But you can decide to hold it a little bit longer if you're going to do it from a position trading standpoint. So, we might get back into this if it continues back higher. But again, right now, our bias is towards ETFs, not individual stocks, until we kind of get out of this transition from what's happening with the Qs versus IWM, because that divergence is massive right now. That we've let's just pull them up again one more time of the Qs and see what's been happening. I mean, we've been going straight.
I feel like we're at the optometrist. Do you like camera 1 or
What?
camera 2? Yeah,
Well,
camera. There's a big difference. It's usually not that easy.
Yeah, now it depends on how you're wired. Like we like camera 2 with the IWM, but dip buyers like this. That's just not how we're wired. We like dips within an uptrend. Now this uptrend is severely under pressure on the Qs, because now your high is underneath your green line, which is your 21-day, and your high is now decisively underneath your red line, which is your 50-day. So that's in a weak position. A normal buy the dip is kind of you're extended above your 21-day, you come down to your 21-day and have an upside reversal, closing above your 21-day. That's more of a buy the dip, the way we like to do it. Everyone has their different approaches. Now let's go over to camera 2 or lens 2 with the IWM. And this is how we like to trade, for better or worse, that you broke out of this cup with long handle, decisive breakout, constructive going sideways. I call that just a little shelf that it's built. Now your expectation is, if we get what everyone's expecting out of the Fed tomorrow, not what I'm expecting, but what everyone's expecting, then this should move higher over that 226.64. And even though we have an oversized position in it, there's a possibility that we might add to it, or we might add to the MDY instead of adding to this, or even the RSP, which I'm not sure if we've talked about yet.
Not yet.
So let's take a look at the RSP for a sec. So this is the equal weight of SPY, and it's kind of in between things, right? It's not as strong as the IWM. IWM is as strong as then the MDY and the RSP are kind of together as far as it ran up nicely. It's held most of that, and looks like it wants to go higher. And that RS line for RSP, this is very unusual to be moving that quickly, is really telling you that there's a big shift. Because think about it, this is 500 stocks equally weighted versus SPY that is market cap weighted. And to outperform a market cap weighted, it's because of that shift out of the $1 trillion club that you were referring to earlier. So this might be an area where we add.
Absolutely. So a few, I'm sorry, I was like a little bit distracted because I was looking up some of these factoids that we got from our.
I thought it was just boring you.
No.
Like, wow, if I lost Justin, then I've lost everyone.
So the S&P 500 equal weight index is outperforming the S&P 500 by 4.35 percentage points month to date. That's its widest monthly margin since April 2009.
That's huge.
What was going on in April 2009?
Why don't we go back?
Yeah. So, just spoiler alert, in 2009, what was happening is we were recovering from the great financial crisis, the Great Recession, of 2008. And it was interesting because growth really took a while to come back. What was happening is we had the follow through day on March, I believe it was March 12th, if I'm not mistaken. This day, March 12th, 2009, we were well below the 200-day moving average line. And, a lot of the stuff that was coming back was your Bank of America, which was down at, $2.50, at its lows. Citigroup, they had to do a reverse split just to stay on the New York Stock Exchange. They were in danger of being delisted because their price had come down so low.
Go to a monthly chart on both of those, so people who weren't trading back then get a sense. That was if you weren't trading
50 and change down to 2.5.
Yeah, and that's not some random little tech stock without earnings. Like, these are big, important American worldwide companies that were falling off a cliff. And going back to that time frame, it was way scarier than the COVID time frame. Frankly, we were on the brink of the financial system collapsing globally if things hadn't turned around the way they were. So you do get those big shifts. So it seems like now we're having that big shift, but you don't have that same catalyst as what we had back then. But we do have the Fed shifting, or whether they shift tomorrow, shift at Jackson Hole, or shift next January, they're shifting. It's just a matter of when. And so everyone is trying to jump on the right places. So what did the RSP look like during that time? Maybe let's look at it on a daily and get a sense.
So, not a big thing, but you can see that the relative strength was, was kind of trending up since this bottom. And again, what happened though was you had a lot of your big heavyweights were down so much, and when they were coming back, it did kind of make for more of a equal weight bias, for things doing well, as opposed to just your strong market cap stuff.
Sorry, Justin. It was a lot of people didn't want to buy the stocks that were sticking up, up high. There were a few stocks that were sticking up high. They broke out and failed. I can't remember them off the top of my head. They looked like good bases, but everyone was going into the ones that you were talking about, the oversold things, the Bank of Americas and all of those. Anyways, a little bit of a different time, but that's very interesting that you brought that up, that was the last time you had that type of outperformance. And frankly, our current market looks even more dramatic than this, really. Is that the massive shift into basically anything else. And banks, savings and loans. I have not seen savings and loans and banks make it through my screens the way they are doing now ever. And I've been doing this for a while, and it's just not a place where we normally look. And unfortunately, all the banks that look worthwhile are a bit extended, or quite a bit extended in some cases right now.
One other factoid to share is that the outperformance of the Russell 2000 versus the NASDAQ, this was from a few days ago, so I really should have kind of updated this, but just a couple days ago, looking at a 12-day performance of the Russell 2000 had outperformed the NASDAQ composite by 17 percentage points. And that was the largest 12-day outperformance since January 2nd, 2001. And so again, what was going on in January of 2001? We were, amidst the .com crash, right? So again, if you looked at the Dow Jones Industrial Average at that time, I mean, that was flat. It was like, what? There's no problem here. Even if you looked at the S&P 500, not nearly as dramatic at that time, but the NASDAQ was getting crushed. And the Russell 2000 just, it was holding up. So the outperformance wasn't necessarily coming from, the Russell was doing phenomenal. It's just that the NASDAQ was so bad at that time that the Russell looked good by comparison, right?
Yeah. And I think that, changing, looking at this time frame really brings home the point that the way the market is structured. So you basically, as far as the big players, you have three different groups. You've got the mutual funds, hedge funds, and family offices. And so let's just look at the mutual funds and the hedge funds. Hedge funds can do whatever they want. So we're going to set those aside with the family offices because they can do whatever they want. But the mutual funds have to stay, 95, 98% invested at all times. So think of that strategy versus our strategy, raising cash, or going on margin or what have you. They're always staying invested. So that really lends itself to the shifting of going from, large caps or mega caps to everything else, or from, SMH to home builders or to banks or what have you. So they can't pull their money out unless they have assets, people redeeming money. The money is still the same. And so they're just shifting their pie around. Just like every week we show our pie of what we're doing, collectively, everyone is making these big shifts. And that's what we're trying to interpret and see, what they're doing. And tomorrow, again, I just want to restate, it's a big risk event. It's not a foregone conclusion that this is going to work out, that the small caps are going to continue going up, but that is the bet that we're placing at this point. And we'll see what Powell has to say and see what the reaction is.
Mm-hmm. Absolutely. A couple other things that I just kind of wanted to share to bring us back to the current time, and just to kind of, again, chat about some of that low volatility bias that we're at right now. A couple of ETFs that we were talking about. So just to kind of let you folks in on some of our thinking here. We were thinking about some of these low volatility ETFs, and a couple are cows, for instance, COWZ. This is the Pacer US Cash Cows. What this does is it's looking for things that have really strong cash flow, and it does tend to have lower volatility. So this is something that we were considering. It's looking pretty good, like a breakout today. On the small cap side, CAF. This one's kind of already kind of popped out of this area right here. And then we were kind of looking at some other potential ones, including SPLV, which is basically an S&P 500 low volatility ETF. You can see that the relative strength on this has been doing pretty well lately. So even though the relative strength number here is nothing to write home about, the recent action here is definitely something worth noting. SMMV, this is another low volatility. I think this is on the small cap side. ONEV, this is the Russell 1000 low volatility, and XMLV is a mid cap low volatility. So these are just basically what I did was I did a Google search, hey, what are some low volatility ETFs? And these are ones that I, as I was going through the list, there were some other ones like a high dividend and so on. But these were some that kind of caught our attention. And this kind of started, Mike brought up cows, and I was like, you know what? I remember bringing up CAF at one point as one that I had traded. I traded cows too. But anything to kind of add on these?
No, I mean, unfortunately, besides a couple of those, like the Russell 1000 low vol and the cows, a lot of them are already a little extended, so it's going to be tricky for us to add those. But I think that is a place where, this is where we're looking in the pond that we're looking to fish in. And so we're probably going to stick with the ETFs for a little bit until we see some, basically some stocks that already have earnings behind them in their group. And so that's not a risk. And they're in kind of perfect positions. Besides that, we're probably going to lean towards ETFs as a way of managing risk, because this is all about managing risk. And that's, that's the game plan. Try to make it out of tomorrow alive. We'll see. I mean, depending on the reaction, we might have to gun it a bit. If the market if he just comes out and says, hey, we're going to be lowering rates, or he does some, pulls a rabbit out and lowers rates tomorrow and just pulls off that Band-Aid, then
which the futures market would be completely surprised, because there's like no chance right now that the futures market is saying that happens tomorrow.
Yeah, extremely little. Now, what there is zero chance of, and why my interpretation of what he's been saying has to be wrong, because right now there is zero chance of rates holding steady starting the next meeting, not this meeting, but the following meeting. And it's very unusual for the market to go to zero. So if you could do the SME Fed funds futures, you can just look at those percentages. And when something goes to zero, that kind of forces Powell's hand, that he does not want to spook the market. And if you follow him closely, which I do, he's said that before. He doesn't want to spook the market. He wants to let the market know what he's doing because he wants an orderly market. He doesn't want a market ripping up or falling apart if he can help it. So I think you're going to pull up that you were reading my mind, Justin. I think
Yeah. So Lily, if you could go ahead and pull up this this chart right here, and again, this is from the CME. They have a Fed watch, and for tomorrow, it kind of gives you this is how people are trading. So this isn't just like they're guessing; they actually have money behind this. So that doesn't necessarily mean that they're right, because if we went to the past and look at historical here, and if you looked at when the expectations were for a rate cut, man, the market got it wrong. The market was saying, oh yeah, we're expecting 7 rate cuts, this year. And yeah, that's not happening. No one thinks that's happening anymore. Rate cuts were expected to start, in the middle of last year, got pushed back. Oh, definitely happening at the end, at the end of the year, by the end of the year, got pushed back. It just kept on, that can kept on getting kicked down the road. But right now, based on the futures market, we are currently in the 5.25 to 5.5. The expectation, about 95.9%, is that it stays at that level. 4.1% that it gets cut tomorrow. So not zero, but very slim chance at 4.1%.
Let's go to September. Yeah.
So let's go to September.
Yeah.
And
so this what you can see.
We're missing something, right? We're missing a bar.
Yeah.
Where is the 5.25 to 5.5 bar? It's gone.
Yeah, and look at the bottom there 1 month ago. So 1 month ago, if you focus your eyes down there, 1 month ago, there was a 35% chance that things were going to stay the same. Going to zero is dramatic. So the market is kind of pushing them there. So that's where, it's a big deal tomorrow. It really is. It's not the statement of him saying that they're not changing. It's how does he answer questions? So focus on, or what I like to focus on is when he reads off, that someone asks him a question and then he reads something word for word. That's what he's really put thought into, that this is the message that I want to tell the public. So pay close attention to those. The off the cuff comments, sometimes he can get tripped up a little bit. He's learned some lessons the hard way that way. But really the written answers to questions, that's the true message, in my opinion. That's just one person, one random dude out in Austin's opinion of how to interpret Powell. So the one thing he doesn't want to do is cut rates and then have to raise them again. That's why I'm leaning towards him trying to message to the market that he's not going to. But look, Fed funds futures at zero, that's a big deal. Like, that is really a big deal that it's at zero.
Yeah. And again, one of the reasons why this does make tomorrow a little bit more important, and something that we wanted to not be too heavily involved in very volatile single stock risk names. So a couple other things I'll go ahead and share just to kind of wrap it up, because I did mention the low volatility. If you go ahead and pull this down, we'll switch to the market surge again. And I'll share my market surge, and whoop. You mentioned the banks earlier, and I just wanted to say, show some of these, not buckle. That's not the one. KBE, the Spider S&P Bank. Man, this thing has been on a tear. We were kind of looking for an entry into this, and it just hasn't given it to us yet. And this one is very spread out among a lot of different names. You probably have 100 names in there. You don't have anything over 2%. You could also look at KRE, which is the regional banks, similar trajectory. And again, just look at the phenomenal relative strength on both of those. And to your point, also low volatility. Insurance has been another thing that has been looking, very strong. And, you don't think of Berkshire Hathaway. Here's the Berkshire Hathaway B shares. You don't really think of that as being like, phenomenally powerful, but the relative strength on this has been very strong lately. The fact is, our belief is that over time growth outperforms value, but that's not 100% of the time, right? And right now is one of those times where value is outperforming. Just a couple more factoids that I can share with you. S&P 500 value index is outperforming the S&P 500 growth index by about 7.5 percentage points this month.
That's huge.
Largest monthly outperformance since December 2000. Russell 1000 value index over the Russell 1000 growth index by 8.25 percentage points this month. Largest since February 2001, which we looked at earlier. Russell 2000 value index versus the Russell 2000 growth only by 3.69 percentage points. The largest outperformance since April 2022. The Russell 2000 is so strong, right? Right now, it's, maybe not that big of a difference between the growth and the value. And then the Russell 3000 value index is outperforming the Russell 3000 growth index by 8.09 percentage points this month, on pace for its largest monthly outperformance since February 2001. So, again, value outperforming growth, small caps outperforming, large caps. That's where we're at right now. And also another reason why we're gravitating towards those lower volatility areas.
And this could be the beginning of a long move in those areas. Like this could just be the very, very, the first part of the first inning of this game. And so we will see. We want to keep an open mind. We're going to stay flexible. I suggest everyone else do that as well. Just, you can have your opinions, just like I have my opinions of Powell and what he's going to do. Opinions are worthless. What the market actually does is the only thing that matters. So we're just going to interpret that. Probably going to do very little, if anything, tomorrow, unless it's, late in the day, and then looking to do more things on Thursday and Friday, based on how things are. And the tricky thing is, everything worthwhile is going to be extended. So we're going to have to be, that is going to be a hard one, because like what you said, those banks, those smaller bank ones, that's your best play right now. But they're, up there. So from a swing trading standpoint, if we put them on here, we could easily get knocked out of them. So we'll have to look at everything, play out all the different game strategies, the way, how do you always phrase that, Justin, of the different, looking at things in
different scenarios, if then
scenario. Yeah. The different scenario analysis. And we'll just look at everything. And sometimes you just got to stretch and buy something. And Bill would do that often. I used to co-manage or manage a list that like SwingTrader, but it was for institutions with Bill O'Neill back in the day. And there were times where stocks would just get away from us. And we'd be talking about it on a Sunday, and he'd say, we just got to put it on. If we don't put it on now, it's just going to keep going without us. I know people call that FOMO and everything, but look, Bill would do it. And I always think if Bill did it,
David Ryan calls it mental health buys, right?
Mental health. But Bill wouldn't do it. David Ryan would do it with a small amount. And I think that's wise. I think that's smart. I love that little terminology uses. But Bill would just, no, we're going to put it on. This is where leadership is. And then you buy it. You have your stop loss. If you get stopped out, that's just part of the game. So if we put on anything a little bit extended, you don't have to play along if you don't want to.
Mm-hmm. One last reminder, just two more charts that I'm going to show as a reminder on the market surge. For those of you wondering about the power trend, power trend is nearly over, right? The 21-day moving average line is in a downtrend, about to cross below the 50-day moving average line. That would officially end the power trend, but that doesn't mean it's gone for good, right? There's a lot of times where it can end and then start up again, so that will be something to watch. And also, look, the IWM, that power trend is just started, so we don't know how long it's going to last. We never get that information ahead of time. We just know that's where it is right now. And, it's worth kind of, again, just remembering that the 21 above that 50-day moving average line and trending above the 21-day moving average line is happening on the IWM. On the NASDAQ, it's the opposite. The 21 is about to cross below the 50, and we have been trending below that 21-day moving average line. This is our 5th day, what we call an S7, trending below the 21-day moving average line on market school rules. And that's something that maybe we, depending on how this goes, maybe we chat a little bit more about that next week.
Yeah. And then there's one other thing that turns it off essentially is if, or puts your count to 0. And that is if you get a circuit breaker where you're underneath your 50-day and you're 10% off your highs, that if that happens, then, for this index, that would put that circuit breaker on, but not for the Russell. So just, keep that in mind. It's the biggest divergence I've seen really since the 2000, 2001, 02 timeframe. I remember Bill, and you remember this, I'm sure, that Bill was saying that there was, during the 2000, 2002 .com bubble bursting, that there were pockets of time where the home builders were working, small caps were working. He started using the S&P 600, I believe.
Right,
and
which is a small cap index as well.
Yeah, so it was kind of, he gravitated towards the S&P 600 versus the Russell, but they're in the same family. So he was saying, oh, we've got a follow through day there. We're going to play over there, and we're avoiding all the .com type stuff. So always flexible, just learning from what he did. And are we pretty much done? Because I had one last thing I wanted to say. So normally don't talk music on this show, but today is a big, important day. It's Buddy Guy's 88th birthday. We don't always have legends with us that long. So if you're a big fan of his, play some of his music. It'll put you in a great mood. If you've never heard of him, you don't know who I'm talking about, Google Buddy Guy. And I think he's still doing a tour right now. His farewell tour, I suggest going out and seeing him. I think he's the best entertainer that's still alive right now, and you will not regret it.
Mm-hmm. Well, I thought you were going to say the birthday legend of my son. He's only 10 though, so he hasn't gotten legendary status, but he's a legend in his own mind. So we had a Star
Wars. Tell him happy birthday from me, please.
We had a Star Wars birthday for him this weekend, so he really enjoyed that, and had friends over, a lot of family, and we're looking to either go to Dave and Buster's tonight or just chill out, have pizza at home, and watch a movie in the backyard. So we'll
and
see.
You have like 100 screen projector type deal right in your backyard.
100-inch screen in the backyard.
That's awesome.
We put stuff on. Yeah. So yeah, we'll see if we end up doing like a Despicable Me Minions type thing back there.
What about Cars and Nemo?
He likes them. But Despicable Me 4 just came out, and so he was like, we got to rewatch that. We also watched Back to the Future, the whole trilogy, and he wants to rewatch Back to the Future too. Because he thought it was funny that it took place in 2015.
Does it get better than Back to the Future? I don't really think it does, especially the first one.
Yeah. So
we're off the rails now. We got to cut this.
Hey, thank you so much for joining us, everybody. We will see you next week. Bye-bye now.